So thanks for joining me today on this podcast. We're going to do a slightly different format today. And for those who are just on listen mode, I'll try to explain things in a lot more detail. Certainly, I would encourage you also to check out my YouTube channel where this is going to also be available. And because I'm going to go through some slides and some details on things that hopefully will bring to light and give you more clarity on a topic I think is potentially confusing to a lot of people. As listeners to this podcast, you may be familiar with the infinite banking concept. We talk about that in different ways and how it helps us to maximize the financing we have for investments and purchases, and really allows us to have more control over that. And so the tool that underlies it all is a specially designed whole life insurance policy. And you'll hear a lot of noise around this in social media, pros and cons to it. And what I just want to do today is to share my perspective on it and equate it to something that you're likely familiar with, which is a home, right? A home is something, whether you buy or rent, I mean, people have at least a familiarity with it and how that works, especially buying a home and getting a mortgage. So I want to show that to you to hopefully give you a perspective on the almost simple nature of what these sort of contracts and assets really look like and how they behave. And so you can get a better sense of what we're talking about here. It is not this mystical asset that does everything, but it's a very flexible tool once you get to understand it. So life insurance, as the title in here would suggest, that life insurance can be a valuable asset like your home, right? And that's where I actually personally, when I'm using this sort of process and tool to manage the financing arm of my life, it is used to invest in things like rental properties, even buy homes. So it's potentially a valuable combination that you can use. So let's start at the very beginning, because just like any asset, you have to actually start it, right? And that comes with buying it. So when you think about for a home, and for most people, we're just thinking very traditional here, that you have to have a down payment, and then you're going to get a loan from where else? The bank. And you're going to go through a pretty rigorous process to check things like your income and your credit score, all those things. And then they're going to give you a mortgage that, let's just simplify it and say it's a fixed mortgage. So you're putting, say, 20% down, and then you have fixed mortgage payments for the balance. And obviously the bank's taking some level of risk because they're giving you money that you hopefully can pay back, but you might not. So certainly that early on, the bank's at risk. So on the whole life insurance side of things, there's also a process to go through to secure this asset. You're not guaranteed to get it, just like a loan, right? You have to be in good health and have resources to be able to afford things like life insurance. So they're going to go through some underwriting to validate that what type of risk you are, just like a bank would. And just like a bank, there's going to be a fixed premium that you can pay, that you'll have to pay, similar to a mortgage, and it's a premium. They call it a premium. So you're going to pay this into this asset, and the big down payment you make here likely won't be as equivalent to like a home, but you do need to start funding it to get it going. And then there's a sizable risk that the life insurance company takes, because once you pay in a small amount, then there's a death benefit for the value of the asset that will be paid to your heirs if you died, right, in the form of a death benefit. So it's very much similar in nature, where you're putting almost like a down payment or starting payment into this larger asset that you're going to be paying into over time. So when you start making those payments, let's start with the home again. Like, where do your dollars go as you're paying into this? So from the home side, obviously you have a principal interest. There's a loan that you've taken out, so the interest is obviously going to the bank, and then a portion of that is buying down and paying down your debt, so building up some equity. So obviously early on, most of the dollars you're putting into it from the mortgage is going to fund the interest, and that's a broader discussion around the volume of interest that goes into something like this is substantial, certainly early on. But just to simplify for our discussion today, is that a piece of the dollars you put into your mortgage go to paying down the debt, and then most certainly early in the life of the loan is going to interest. And so you're building up more equity, hopefully, even if the house isn't appreciating value. So in this case, the equity in your home actually has really no rate of return. It's just piling up there. Obviously, you're paying down your debt, so your principal balance continues to go down, but that equity actually earns no return for you. On the flip side, from the whole life insurance policy, we talk about premiums. And so a portion of the cost is going to pay for the insurance, right? You're getting protection against your life. So that comes with a cost. And so early in the policy, you're going to overfund this policy, this asset, and it builds up cash value, right? Depending on how it's structured, right? Some of them won't have any cash, but the way we design them, you're going to be able to have cash early. That's building up equity. So it's just a split. And over time, just like a mortgage, the older it gets, the more that goes into building up equity, and in the life insurance side, cash value, right? But early on, a lot of it's going to protect the bank and the life insurance company. They're both acting like a kind of financing source. Now, the good part about the whole life insurance side is that within the contract itself, there is a guaranteed rate of return of your cash, right? That's going into this policy. This policy is going to earn. It is definitely not an investment in that case, and because the risk profile is very different, the contract is guaranteeing certain cash in there, and obviously the death benefit. And so this is not really an investment, but there is an interest rate tied to your cash. Now you have an asset. So how do you add to this asset to make it more valuable? So obviously, when we think about a home, you may have an addition you make to the house, or an upgrade that hopefully adds value to the house. So in the scenario we're talking about, say it's a $500,000 home, you put $25,000 of a reno. Hopefully, it goes up by at least that much. Maybe, hopefully, maybe more. But let's just say it's even. So your $500,000 home with a $25,000 addition now is valued at $525,000 if you need to sell that, right? So pretty straightforward. On the whole life insurance side of things, the way we design these policies is that you can actually add more premiums on top of your base premium flexibly along the way. And what that does is it builds up the cash value faster, right? In traditional whole life insurance policies, there probably isn't tons of cash to begin with, but we design them in a way, and it can be designed uniquely, but depending on your situation, to be able to add more cash in. And really what it's equating to is you're buying life insurance, little snippets of life insurance that completely are paid off, right? Just like you purchased an addition in your home, here you're buying life insurance contracts and death benefit that's completely paid off. Now, depending on your age and health, $1 going into it as an additional premium contribution could equate to 2 or 3 times that amount in a death benefit should you're adding. So in the same example, we talk about the $25,000 addition to your home. You could put $25,000 into your whole life insurance policy as an added contribution, and you can raise the death benefit potentially 2, 3 times, maybe in this case, $75,000 for $25,000 contribution. So you have a kind of a leverage going on here because you're paying it off, and that money's going to build and grow over time. So notwithstanding that, what happens to the change in the asset values over time? So for a home, historically, let's just usually say around the house value goes up by inflation, right? Over long periods of time, say 3 to 5%. Absolutely no guarantee of that, but that's what we've seen historically. So, and there's going to be cases where that falls, right? So depending on where we are in the cycle of things, there's no guarantee of it going up. But historically, we have seen that, so it can rise. So in our scenario that we're looking at, your $525,000 home increases by 25,000 to 550, right, over time. Now, in your whole life insurance policy, there's an added benefit that is not guaranteed, but because of the types of companies we use, we're part owners of that insurance company. It's called a mutual insurance company as opposed to a public stock-owned one where most of the dividends go to the shareholders. Well, being in a mutual insurance company sort of structure, you as an insured member are get part of the profit, and that comes back to us in the form of a dividend. Now, that's not guaranteed. However, they've been paying that for well over 100 years, and the expectation is that it's going to continue on. All the ones I've owned, all of them have paid dividends every year that I've owned them. And so what that ends up doing, which is one option to do, is you use that dividend to buy additional insurance that builds up your cash value and then grows your death benefit on top of that. So again, those dividends over time will help increase the cash equity position in your policy, but then your policies also go up as well over time. And that's a good thing, especially when we're dealing in times of inflation that, our dollars are not going to be as valuable. They lose value every year we own them. So we always have to fight against that inflation target and growth that's going to erode the value of your dollars. Now, as you're building up equity in either your home or your life insurance policy, whole life policy, how do you access those dollars? Well, obviously, when you're owning it in a home, one of the ways is you could refinance these things, right? And get a brand new loan and start the cycle over and strip the dollars. But one of the other options is securing a line of credit against your home. So there's a secondary loan against your home where you can access part of the equity you've built up. So in the one example that we're showing is that over time, as the value of your home is increased and you're paying down your mortgage, that now you have a $200,000 worth of equity. An example in this scenario, because the banks still want to be protected, they're not going to let you access all that equity. So they'll let you maybe access, let's say, 80% of the equity. So in this scenario, then your $200,000 of equity, you can access 90,000 of it. So about 45% in this scenario, right? That's going to change over time, but this just gives you a set point in time when you can access it. So it won't be the entire amount of equity, or because the banks need to still protect themselves from changing values in the asset. And then when you're paying that, you're going to have to pay back interest if you use that line of credit. You're required to pay something on a monthly basis, and there is a chance they could take that line of credit away at some point. So they're not guaranteed to give you that line of credit. On the flip side, on the whole life insurance policy side, there is embedded within the policies a contractual loan provision. And that allows you to borrow against your cash value, not from your cash value, against it, using your cash value as collateral. And it's really your death benefit because they expect you're guaranteed to eventually leave this earth and graduate. And so they're going to give you, because of the nature of the life insurance, they would have taken our money and invested it. But now they're going to give us a chance to borrow it for any purpose we want when we want to use it. So in most companies, it's either 90, 95% of the equity, the cash value, you can borrow that amount to use however you want. And so, and you don't have to go through credit checks. It didn't show up on any credit report or anything. Because it's a private contract, it stays private and it's not shown anywhere. So you can borrow that money, use it for whatever investments, buying education, whatever the situation, car, and then you pay that loan back to the life insurance company because you borrowed their money, not yours. And you can pay that back on your terms, right? Your payback schedule. There's an interest rate to it, just like any loan you're taking from a bank or any institution, but you have the freedom to choose when you pay this back. And being an honest banker, and we continuously preach that in the infinite banking concept sort of philosophy, but you have some flexibility when you pay it back. And there could be a point in time it might make sense that you never pay it back. And then when you die, the larger death benefit pays off your loan and the rest goes to your beneficiaries. But you have a significant portion of your equity available to you and flexible loan terms. So what are the other benefits or things to think about? Well, as life goes, we hope to live a healthy, long life, but things happen, unfortunately, and we can't always predict that. So two of the big things that happen, and you're more likely to get disabled early, or you actually might pass and die, unfortunately. We don't want to think about these things, but they can happen. So think about it from the house side. If you did die, Let's start with being disabled first. If you get disabled, hopefully you have some level of disability insurance, but most folks have insufficient amounts. So it might make it difficult to continue making those mortgage payments into that house, right? So you may need to sell, and I've had this happen before with others, or it could go into foreclosure, right? Because you can't make your mortgage payments and banks start taking it over. Certainly, if you died, your heirs may not be able to make the payments on it, right? It'll transfer over. So you may need to sell it and get that equity. And there's certainly costs to sell the properties. A good benefit is that it's going to come over and be free from capital gains taxes because it gets stepped up. But when you die, it still might be a burden on folks, and you may have to liquidate this asset. Now, on the life insurance side, if you've added this sort of benefit to the policy, you can have a disability waiver premium, which really helps if you get disabled. The life insurance company will continue to make your premium payments for you, continue to build the cash value, and protects the death benefit and secures the protection for your family. So it's a really good benefit to have in the case you get disabled long term, and allows you to continue to have this asset without problem. And the death benefit, like I said, stays with you. Now, if you died, obviously this is what this asset is primarily, is a life insurance policy. So the death benefit will go income tax free to your heirs. And unless you have substantial wealth in your estate, it will also go estate tax free, right? But if you have that issue where you're going to pass on a lot, then there are also ways to mitigate that tax ahead of time through other channels, legal channels. Now, the other thing that's also potentially a concern for folks as they get older in life is the need for long-term care, or you get diagnosed with a terminal illness, something of that nature. Again, this may require someone to sell their asset before they would want to, or start draining other assets, right? That to pay for long-term care if you don't have an insurance. So the home becomes potentially a source of funds to help fund the long-term care, but it might come at a cost, or the draining of other assets. Now, on the life insurance side, a lot of them now have this built-in sort of benefit where you can use your death benefit early before you pass if you're diagnosed with the need for long-term care, or you get diagnosed with a terminal illness. So it's a really nice benefit to have. I mean, a lot of people don't have long-term care insurance by itself anymore. This can serve in that capacity in some shape. It is not long-term care as exactly, but it can play a similar role. You can use your death benefit. And then if you get terminal illness, you can also extract some of the death benefit early for medical care, or to help make the last years of your life a little bit more enjoyable. So it's another added benefit on top of the death benefit, but it's something to consider. Now, the last thing I want to cover is about retirement. And I'm not personally a big fan of that term. The definition I've come across that really rings true to me is to put out of service. That doesn't sound overly great, but listen, I say transition or evolve, right? So, but some people want to go in retirement. So, what do you do with the house? Well, this is a challenge for some because they still want to stay in the house. But how do you get the money out of the house, right? So you could do a reverse mortgage to help bring in some tax-free income. Comes with a little cost, and fees to it, but it might be a viable option for folks, especially if you want to stay in the house. Most people will downsize, sell it, and depending on how much gain there is, there could be some taxes associated with it. But that's it. It has to be a pretty sizable amount. I think 250 for a single, or 500 for a couple, 500,000. So substantial amount, but there are some assets have inflated so much that there is going to be a chance for capital gains. So on the life insurance side, the one beauty of it is that you can withdraw tax free every dollar you put into this policy first. All the amount you contribute. You can do that first, completely extract everything you've put into it. If you put 500,000, you can take that over time as much or little as you want over time. You're essentially selling little pieces of your death benefit to consume the dollars. So you can extract that out. Now, once you've reached your basis or how much you've contributed to the account, then to avoid any tax on the gain that is inside the policy, you can take out that loan provision that we talked about. You can take loans from the policy tax free and then sort of use that for retirement or income. And then when you die, the death benefit will pay off any outstanding debt, and then the rest will go to your beneficiaries. So you have some flexibility if you want to use it in a capacity, but obviously this is where some of the legacy planning can come into play. You can really position those assets to use for legacy planning and tax-free passing of wealth to the next generation, and while still consuming some of the assets inside the policy and cash value as tax-free income while you're living. And so you can do a little bit of both. So it gives you quite a bit of flexibility on it, and there are no rules of when you can use it or how. Completely up to you and flexible. There is no 59.5 rule or anything like that, unless you make it a MEC, which we won't cover today. But for most people, that won't be an issue. So that's it for retirement. So that's all I wanted to cover today. Hopefully, this was helpful and to give you a lens of this asset. I mean, it has some complexities to them, but by and large, they work fairly simply. And if you understand how a house works in terms of contributions and asset growth, it's very comparable. And so hopefully this kind of sheds some light and gives you a flavor for how these work. And if you want to get in touch, certainly you can reach out to me at Cranial Pride. Certainly can help you out. And there's a plethora of resources around this, but hopefully you've gotten some value out of this, and we'll see you on the next episode.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.